I know that when the market goes down, it doesn't feel good. Envision this. You get your statement at the end of the month. Your balance has gone down. It's concerning because a lot of people use this term, which I cannot stand, is they say, I've lost money. Well, the only time you lose is if you sell. Now, I've said this for many years. There's only three things that you can do when the market goes down. Number one, that's buy. Number two, sell. Number three, do nothing. Well, a lot of times when I share these valuable principles, I just share the concept. And I don't normally always have a good visual to back it up. Until today, a good friend of mine sent me this visual, and I want to take a look at it together. Now, let me set the stage for what we're looking at here. Across the bottom, you can see that the time frame that we're looking at here starts in 1980 and goes to 2021. Now, along the right-hand side, there's $3 amounts: 1.9 million, 1.2 million, and 569,000. Well, if a person were to invest $10,000 in the S&P 500 in 1980, I want to show you how three different behaviors would have resulted in the three different dollar amounts over on the right-hand side. So investor number one puts his $10,000 in, or her $10,000, and every time the market dropped by 8% or more in a month, they added more money. And that's how you get to the 1.9 million over on the right-hand side. Now, investor number two exhibits behavior that they just ride it out. They buy and hold. Their $10,000 grows to be 1.2 million, which is no chump change. That's a fair amount of money, especially for not having to do anything. Number three investor, behavior number three, they're apprehensive, and every time the market drops, they move $2,000 out of the market, selling when the market is low and buying something that is quote unquote safe. They end up with $569,000. You ask yourself, how can a market correction be beneficial? That visual exhibits it perfectly. If you've got the ability to put money into the market when it goes down, that's a great thing. But a lot of our investments pay interest and dividends, and so it automatically reinvests. Those dividends and income automatically reinvest. So we're dollar cost averaging when the market's going down. This visual is a fantastic one to show us how a market correction can benefit us. If you have any questions about this at all, don't hesitate to reach out. Have a great week.